Well, my task this morning is to introduce a member who is more than a pretty face. Every once in a while, something good comes out of Ontario. Matt Carter was born in Mississauga, and having graced that province with the emergence of his existence, decided to move to beautiful British Columbia, taking his parents with him, where he majored in high school football. Then, feeling the pull of the Atlantic Ocean, where he passed up the opportunity of being one of the boys in the band, he instead became a football hero on a scholarship, playing wide receiver for the Acadia Axemen football team. He also took time out to study human kinetics, home economics, and lobster pot construction, graduating as an academic All-Canadian football player, and Acadia Male Athlete of the Year. For those of you familiar with college football, the bonds that are formed in playing the sport at that level are lifelong. And Matt's experience was no different, as he keeps in regular touch with his university football team head coach. Upon graduation, Matt was drafted into the CFL and played wide receiver for 7 years. First with Hamilton, playing with the amalgamated team of the Hamilton Tigers and the Hamilton Wildcats. Then to the frost-bound Edmonton Oilers, and thence to the newly formed franchise, wait for it, replacing the dearly departed best football team ever to play for Canada, the Ottawa Rough Riders. He played for the Ottawa Red Blacks, a thoroughly exciting and rewarding experience, despite a 2-16 win-loss record their first year. Matt spent his whole football career at wide receiver, at a position far removed from the rest of his team on the field. He explained that he couldn't tackle worth a darn, and this was the only position that football coaches were willing to place fast white guys who constantly argued with quarterbacks when they called running plays. Having spent an inordinate amount of time having his body patched together on a training table, Matt abandoned early thoughts of becoming a chiropractor or physiotherapist and plotted a way to become a business owner in the marketing and financial field. Having met Leanne Keating, and under the ever watchful eyes of Mike, now he's not your average size wide receiver, or of Jennifer, Matt joined Edward Jones Canada. Matt and Leanne have 3 children, Ruby, Austin, and Vivian, who turns 1-year-old tomorrow. Fellow Rotarians, friends, and guests, please welcome to the Zoom podium the man with a 6-stroke golf handicap who will explain to us the intricacies of lowering our handicap in planning our financial destinies. Matt Carter.
Wow. Thank you for a lovely introduction, Dr. Murdoch. I learned a few things about myself this morning, so that's always a nice way to get started on a Friday.
I can't hear you.
Can you hear me now?
That's better.
Okay, perfect. Can everybody else hear me? Mic check.
Yeah, everybody else can hear you.
Perfect.
And you turn the volume up on your speakers.
All right, we'll keep going. It wasn't that long ago, early in January, Dr. Murdoch and President Ann asked if I would be interested in speaking to the club. I agreed to do so, thought it would be a fun opportunity. When I agreed to do this, I did not expect to be presenting via Zoom, but this is the environment that we are in. At the same time, I didn't know what I was going to speak about, but I informed them that as we got closer to the presentation date, that I would find a topic that I thought would be of interest to the club. It's been an interesting couple of months, to say the least, with regards to this virus, the effects that it's had our economy and specifically the stock market. So I thought diving into that today would be of relevance and might be of interest to a number of Rotarians. So before we get this thing going any further and I share my screen, I do want to find out a little bit of information. So get that chat bar opened up on the Zoom platform. And purely out of curiosity, I just want to know, and just be honest, how many people in this club would say you actively follow the markets? Just give me a yes or a no answer. And don't be embarrassed to say no, that's why I have a job. Kind of, a couple of kind ofs. Just type something in for me. Okay. Lots of yeses, lots of nos. Makes sense, is what I expected. Let's take it one step further. I'm going to give you, what I'd like you to do is I'd like you in one word to keep that chat bar open. And for those of you that are following the markets, describe to me how you're feeling today about the state that we're in. Jason. Frustrated, nervous. Laszlo loves it. Don't look at my statements. Everything's on sale. So those are all terms and emotions that I've heard from a number of our clients over the past couple of months as we've been chatting with them. Okay, I'm going to share my screen now real quick. Just let me know if you guys can all see it. Are we good to go? You guys can see my screen? Okay, perfect. So the title of my presentation today is Outlooks and Opportunities. We're going to take a little bit of time and we're going to go through what we've seen in the markets over the past couple of months. We're going to talk about some of the challenges that lie ahead. And most importantly, we're going to talk about some actions that you can all take to put yourself in the best position possible when this does come to an end. So with regards to the markets, 2020 started off just like 2019 came to an end. 2019 was a strong year for the markets, to say the least. It was the best year that we've seen since 2013. But things changed, and things changed quickly near the end of February as this pandemic, as this virus took toll and began to spread. If we take out the other piece that often makes up a decent amount or a portion of clients' portfolios, if we look at bonds also did extremely well in 2019 with some help from rate cuts. But even that wasn't enough to keep people above float in the midst of this market sell-off. So one way to look at this presentation today is kind of like a puzzle piece. So we're gonna explore a number of topics, and then we're gonna put them all together and talk about how it fits into a cohesive whole. So here's some of the questions that I've been getting over the past couple of months, and they may be similar questions to what you've been asking at the same time. So question one, or puzzle piece one, will we see a recession this year? How low will interest rates go? Could they go negative in North America? My favorite is, Matt, how long is this going to last? When does it end? And spoiler alert, I do not have an answer for you today. Question four, will global markets keep underperforming? There's an election this year in 2020, so that's going to be comedic to say the least as we get closer to that. Some of the risks to our outlook, common mistakes that I can make, or common mistakes that I can avoid, pardon me, and then how do I put this all together? So I'm watching my clock. We've got a lot to go through, and a couple of these slides we're going to skip over just because I'm not going to have time to get through everything. So question one, will there be a recession this year? So if we take a look at this, we know that the global economy is facing some challenges as we move through this virus. So our isolation efforts were needed and were warranted to slow it down and to flatten the curve, for lack of a better term. But we know that the economy is in a challenging place right now and moving forward. If we take a look at the economy, okay, there's four main pieces to the economy: consumer spending, which makes up the biggest portion; business investment; government spending; and net exports. So the part that I want to take a little bit of time and discuss right now is consumer spending. So in Canada, we as Canadians make up about 60% of GDP. So I go to work, you go to work, money comes into our pocket, and we use that money and we buy goods and services. So that spins the economy around. If we look at our neighbors to the south, consumer spending makes up about 70% of the US economy. Okay, so temporarily there'll be a hit to that aspect as well as the other three, but we do feel, or I do feel, that moving forward as we get into the back half of the year, maybe a little bit later into the year, that some of this can begin to rebound. The good news to all of this is that before, the COVID pandemic began, the Canadian economy was really strong, and so was the US economy. If we take a look at this right here, we got an idea as to what's been going on with the unemployment rate over the past number of decades. So the green line that you're seeing right now is the unemployment rate. I can't see because I gotta minimize you all. As we get over here onto the right-hand side, before COVID hit, the unemployment rate in Canada was at a near 40-year low, which is a good thing. And if we look at our neighbors to the south, their unemployment rate was below 4% and at a near 50-year low. So these conditions are important to remember as we come out of COVID on the other end of this thing. Now, through these efforts and through our efforts to help slow the virus and try to contain it, unemployment rates have obviously changed significantly in a big way. So our April numbers that we have, our most recent numbers, the Canadian unemployment rate now is up to 13%. And the US unemployment rate has climbed up to 14.7%. So those are big numbers. And to put it in perspective, during the global financial crisis back in 08-09, the unemployment rate in Canada reached about 9%. Now, the silver lining to this, or the good news, if there is any, is that specifically in the US, 80% of people who have lost their job have been deemed temporary layoffs. So when the economy gets reopened and we start moving back to a new normal, a lot of these people will have jobs to go back to. Not all of them, obviously, but it's not going to look anything like it does today, which is obviously a good thing for our economy moving forward. This slide right here is taking a look at inflation over the past number of decades. So the green bar, or the green line that you see going up and down, are inflation rates at different times throughout the past number of decades. And then if we take a look at the yellow line, that's core inflation. So all I've done is I've stripped out energy and food prices, which especially energy, as you've seen this year, tends to be a little more volatile. So over the previous expansion, so from, let's just call it the last decade, 2010 through the start of 2020, inflation has been really low, right where the Bank of Canada and where the Fed try to keep it. Moving forward, not expecting to see any massive growth with the rate of inflation. This will also help moving forward. We're not going to spend any time on the housing market just from a time perspective. To put things in perspective, to answer question one, will we see a recession in 2020? Well, recession data is backwards looking. So for there to be a recession and those alarm bells to get rang and to read that on the Wall Street Journal or see that news on BNN, like I said, it's backwards looking data. So you need to see two contracting quarters of GDP, so two successive quarters of negative GDP for a recession to get rang. So in our minds, or in my mind, I don't think you need to wait for this data to come out where we know we're going to see a temporary recession moving forward. The second piece to the puzzle, second piece to our puzzle has to do with interest rates. Will they go lower? Could they even turn negative? So this slide right here is showing you where interest rates have been. Okay, so there's been times where interest rates have been going up and times where interest rates have been going down. So the Bank of Canada and the US Federal Reserve will cut interest rates in periods to help speed up the economy or help the economy. When rates are going up, the central banks are trying to slow down an overheated economy. So we take a look at where we're at right now. The benchmark rate in Canada and the US has been slashed significantly, okay, which helps with our consumer spending. To put it in perspective, our mortgage has decreased by about $150 on a bi-weekly basis just from interest rate cuts over the past couple of months. So this is a positive thing moving forward. And the other monetary policies that we've seen happen are, well, quantitative easing. So you've seen the US Federal Reserve, for example, buying bonds aggressively over the past couple of months to keep credit flowing to businesses and consumers. And for the first time in history, For the first time in history, earlier this week, the US began buying corporate bonds, which they've never done before. So this isn't going to fix the problem, and it's not going to fix the problem tomorrow, but I do believe it's going to help with the situation when we do come out on the other end of this COVID mess. In other developed countries, parts of Europe and Japan, you've seen negative interest rates. So a couple people have asked over the past couple of months, do you think North America could go to a rate environment where interest rates become negative? And this presentation was made a month ago, but the quick answer to that question is no, we don't expect in North America to see negative rates. And actually on Wednesday, Jerome Powell, who's the head of the Fed, came out and said that that's something that they're not looking at doing at this time. So there's a couple of reasons for that. The first reason is there's no evidence that negative rates have actually really worked to help pull economies out on the right end. And secondly, and more importantly, the central banks in North America are using other monetary policies, such as quantitative easing, or buying all these bonds to provide liquidity in the market. And that, we believe, will have more effect than negative rates. My favorite question right here is when is this going to come to an end? How long will this last? Is there some questions coming out of here? Okay, no, we're good. How long will this market slump last? The short end to this question is I can't tell you where the bottom's going to be or how long it's going to go. What we have seen, though, is we've seen two very different markets over the past couple of months. So to put things in perspective, from February 19th to March 23rd, the market pulled back by 34%. So it took about 22 trading days for that market pullback to happen. And that's the fastest 30% pullback that we've seen end of bull market in history. So it was something. On the flip side of that, though, we've seen the markets rally about just under 30% from their lows from end of March up until early in May. So we've seen the markets go both directions moving forward. I'm not going to try to predict what's going to happen short term. I do believe long term there's still lots of opportunity with the markets, but there's still a number of hurdles that we need to pass. As unsettling as market pullbacks can be, and don't get it twisted, I get how scary it can be. There's three key takeaways that need to be put into perspective. So the first takeaway is that initial conditions do matter. So before this started, the economy was strong. So that's a good point. The second point is that the Bank of Canada and the Federal Reserve and other central banks have taken massive action to help this problem. Okay, it's not going to fix the problem right now, but it will help when we come out on the other side. And the third point, and the most important point, I believe, is that a diversified portfolio and the way that most people have their money managed looks nothing like the market. And that goes in both ways. So when the market is roaring, you're not going to keep up 100%. And then when you go through an event like we are right now, you're not going to be exposed to that pullback either. So those are three really important parts to keep in mind as we're moving forward throughout this COVID situation. Is Dave Pickering on the call?
I am on the call.
Okay, I'm going to call on my good buddy Dave Pickering here. So, Dave, I got a question for you. Why would an individual, why would a retail investor take their hard-earned money and use that money to go out and buy shares in a quality company, or use that money to buy units in an equity-based mutual fund or an ETF? What's the thought process behind that?
Well, every time we've had a pullback in the market, the market will eventually reach new highs, whether that's 12 months from now, 2 years from now, who knows? But I believe the market will eventually reach a new high sometime in the future there.
Okay, I love it. What I'm looking at right here, this slide right here, is when I'm buying, or when we're buying companies for our clients, whether it's through an individual stock or whether it's through a mutual fund, we're buying companies that we believe over the long term have the ability to increase their earnings, i.e. to make more money. So the slide that we're looking at right here, the yellow line that you're seeing is the S&P 500, which is an index that tracks the 500 biggest companies in the US. And then laid in behind that, this gray bar, are earnings of the S&P 500, or earnings per share. So earnings per share is just a company's, or in this case, the market's total earnings divided by the outstanding number of shares around the world. So what you'll notice is that as companies make more money, okay, often their stock price will follow. So I could take this chart and I could pull up a name like Visa, for example, and we could chart Visa's stock price over time. We could lay over their earnings over time, and you would see a similar trend. As their earnings go up, so does their stock price. So when we look at this, we know that earnings temporarily, with a lot of these companies, are going to take a bit of a hit, and it makes sense, right? If you just think of a name like, I don't know, like Starbucks, for example. Well, Starbucks was shut down in China for a couple of months. So the market isn't going to be overly surprised when they come out and report, hey, we didn't sell very much coffee through January and February in China. Not a surprise to the market. What we've seen over the past couple of weeks as Q1 earnings have come out is that there's been, for lack of a better term, a bit of forgiveness, right? A number of analysts have had to revise earnings and try to figure out, how many widgets are going to be sold by each of these companies. And so far, companies haven't been getting as punished as maybe many thought. Now, does it mean that we're done with this? Absolutely not. What appears to be happening is the market's trying to price in right now, what are earnings going to look like in the back half of 2020 and moving into 21? But this is a really important chart to keep in mind because, again, we know that over the long term, the broader economy, earnings will play a factor in what happens with the stock market. Not going to spend too much time on this slide right here, but what I'm trying to show you here is these green bars are years in which the S&P 500 was up 20% or more in a year, and then the gray bar is what happened in the market the subsequent year. So last year, 2019, was a year in which the market was up more than 20%. Obviously, this year we're below this graph right now. As of yesterday, the market was down. The S&P 500 was down about 12% yesterday before the markets open. I haven't checked where they're at today. So we'd have a little ways to go in order to get up to this yellow dotted line, which is the average of what the market has done after a 20% pullback. But the point that I'm trying to make right here and moving forward in subsequent years is you don't need to move out of the market after a strong year. For whatever reason, there are retail investors that believe that. Fourth piece to our puzzle, will global markets keep underperforming? Okay, so this chart right here that we're looking at is showing you how overseas developed markets have done over the past decade or so. And you'll notice that in their local currency, in 8 of those 10 years, they've had positive returns. Just keep in mind when you're investing your money in Canadian dollars outside of Canada, currency will play a factor, right? So moving forward, we see opportunity in this area of the market, not for your entire portfolio, but for a portion of your portfolio, and not expecting to see any major movements in the dollar anytime soon. We're just going to skip over this slide for time. Spend a little bit of time on this chart right here. So what you're looking at right now is the Purchasing Managers Index. So that's this green line that's going up and down over the past 2 decades or so. So anything you see above this red dotted line is just call it good news. It represents an expanding economy, and anything below this red dotted line can be viewed as contraction. So the positive to all of this is that before COVID began, we were starting to see a little bit of growth over here. Now things have changed since the virus started, but again, the actions that have been taken by central banks and governments will help stabilize this once we come out on the other end of this situation. There is an election this year in 2020. I can't imagine what the headlines are going to look like as we get into November and move forward, but I imagine it'll be comical. I wouldn't be surprised, and don't be surprised to see the markets move short term as we get closer to the election. That happens all the time. But long term, no matter what party is in power moving forward, it's not going to have a drastic effect on what happens long term with the markets. So the broader economy plays a much larger role in what's going on with the markets than whether Trump gets reelected or not, or whether it's a Republican candidate or a Democratic candidate that's running the U.S. So expect to see a little bit of moves around the election, but it's not going to drive long-term stock performance. Some of the risks to our outlook moving forward. Okay, well, in one word, just to describe one of the major risks, we'll look at debt. So that can come in a number of forms: household debt, corporate debt, and fiscal debt. So if we were to break this down one at a time, right here, we're taking a look at household debt in Canada over the past number of years, and you can see that household debt in Canada has risen over time. So to put it in perspective, household debt now represents about 102% of Canadian GDP, or to put it another way, for every $1 of disposable income that we have coming in, we owe about $1.76. So every dollar, we owe $1.76. So the size of our debt load could eventually slow the recovery once economic activity resumes. So that is one challenge, or one issue to keep an eye on. Another factor, corporate debt. Again, this chart right here, the green line that you're seeing is the S&P 500 over time. In behind that, the gray portion to the bar is the amount of debt that corporations have taken on or borrowed during that same time period. Now, during the expansion, let's just call it from 2010 through 2020 again, interest rates were low, and a number of corporations were incentivized to borrow. Now, we know that it's a challenging time for a number of businesses right now, and there are some businesses that will be hit harder than others, and unfortunately, there will be businesses that don't come out of this. So the potential for defaults will also play a factor in some of our risks to our outlook moving forward. Let's spend some time right here. This is the key piece to the outlook right here. So these are common mistakes that we see retail investors make during times of uncertainty. I don't have the exact numbers, but there was an article that came out in the Globe and Mail, and it was in March, near the end of March. And just RBC Bank branch alone, there was over $3 billion in redemptions in a 1 month period. And that's one of the biggest mistakes that people can make. It's scary, it's challenging to invest through times like this, but we do know that lots of the absolute best days in the markets come in the midst of some really uncertain times and right on the heels of some of the worst. And this has helped highlight that, right? So February 19th to March 23rd, market falls 34%. On March 24th, for example, the Dow Jones is up almost 11.5% in 1 day. And this is a common theme. We see this all the time. So it can be very, very painful to be out of the market when you do get some of these swings in the other direction. Another common mistake that people make on a regular basis is chasing past performance, whether it's an individual stock, whether it's a sector, or whether it's an asset class. So this chart right here is just showing you different calendar years from 2010 all the way to 2019, and which asset class has been the best performing and the worst performing. And what you'll notice on this chart is that leaders rotate all the time. So if you just take a look at 2017, for example, emerging market stocks did really well in 2017. In 2018, they're near the bottom. In 2018, international bonds performed really well. In 2019, they're at the bottom. So getting in the habit of chasing last year's winner can be very, very dangerous. Whether you're going out and you're saying, well, let's just keep buying Amazon because we watched it go from $600 to $2,400, or let's just keep buying U.S. stocks, or let's just keep buying international bonds. If you're chasing, you can get into real trouble. So do your best to avoid that. This chart right here is just showing us the probability of having positive returns when your money is invested in different asset classes. So if you were to invest in 100% of your portfolio in US stocks, you can see the probability of having a positive return 1 month, 1 year, 3 years, 5 years, and 10 years. If we were to change that asset allocation and invest 65% of your portfolio in US stocks, 35% in US bonds, You can see what happens to your probability of having a positive return. And then if we were to break it down even further, a portion of your equity investments in US stocks, a portion of your equities in international stocks, and 35% US bonds, you can see what happens to your probability of having a positive return. So when people talk to you or when you hear diversification is not taking your money and spreading it around to 7 different financial institutions. Diversification is simply the combination between equities and bonds. And then you can break it down a little bit further. What percentage of our equities are going to be invested in Canada, the US, the international space? Which percentage of my stock positions are going to be in technology, energy, financials, consumer staples, consumer discretionary, et cetera, et cetera. So that's diversification, not just throwing money at different institutions. This piece right here, I highlighted a little bit earlier about the importance of not making any knee-jerk reactions. I always say to our clients, my job is to be a voice of reason and a pillar of calmness, whether markets are going up or whether markets are going down, right? We're not going to make any knee-jerk reactions over a couple of moves here and there in the short term. What I'm trying to show you here is what's happened in the market over a 35-year period. So for hypothetical sake, let's just say you invested $10,000 back in 1985. You invested it, you stayed the course. There would have been a number of times throughout that 35-year time period where the media was telling you to sell everything and run for the hills, but you ignored them. You did the right thing. Your $10,000 investment is now worth 71 grand. Unfortunately, lots of times emotions get the best of retail investors, and they'll try to time the market move in and out. So to highlight this is an exaggerated example, but let's just say an individual missed the best 10 days in the market. Their $10,000 35 years later is worth 28 grand. So a significant difference between those two factors right there. And again, to highlight that, as I said earlier, on March 24th, the Dow was up 11% in one day. So this example is highlighting if you miss days like that and you compound that over 5, 10, 15, 20, 35 years, it can have a major piece in what your performance looks like long term. And then you go down and you miss 20 days, 30 days, 40 days, and 50 days, and you can see what happens. So do your best to avoid that. Try to move in and out. Just to understand volatility a little bit more, how often we see pullbacks in the market. They are frequent when you invest your money. It's going to be a part of the process to building wealth. So a dip we're going to classify as a 5% pullback. On average, that happens about 3 times a year. A market correction, which you'll hear in the media all the time, is simply a pullback of 10%. That happens about once every year and a quarter or so. And then a bear market, which is what we hit this year, on average happens about once every 3.5, 4 years. I feel like this time around, it was a little more painful because it had been so long since we technically saw a bear market. So this was the first bear market that we've seen in 11 years. Okay, so people forget just how painful it can be. At the end of 2018, we were close to having a bear market. The market's pulled back 19.5% or so. So pretty close, but didn't officially happen. So this is what we're going through right now is common. It does happen. It's not the first time it's happened. It certainly won't be the last, but I do understand how painful it can be. What I'm trying to share here is be disciplined in what you're doing. And what I haven't showed you is that through these time periods, where we've seen these market corrections over history, we know that the market has increased over time. Over the past 35 years or so, with these pullbacks, the market has been clipping along at a rate of in and around 9% a year. So in order to get that money, you do have to go through some challenging times. This slide right here is just taking a look at how Canadian equities have been performing against overseas equities. So anytime you're seeing these mountains, so these lines over the 0% line, these are years in which Canadian equities were outperforming overseas equities. And then we'll call these parts down here lakes. These are periods of time in which international equities were outperforming in Canada. So what I'm trying to point out here is that as Canadians, lots of times there seems to be a little bit of home bias. You don't have to invest all of your money in Canadian stocks, or you don't have to just buy a Canadian mutual fund. There are opportunities outside of Canada. And at this time right now, we continue to see this space, this overseas space, as an attractive piece for a portion of your portfolio. Putting these pieces together, okay, be realistic. I mean, we're all investing for a certain reason. Speaking about myself, there's two reasons, or there's two goals that I'm working on. One is putting my kids through school, which is going to cost me an arm and a leg 18 years from now, and as things get more expensive. And then one day I want to be able to wake up and head to the golf course on Friday morning at 8:30 and play golf through my retirement on a daily basis. So where I'm going with this is we all have a reason why we're investing. Okay, so be realistic with your financial planning goals. Don't have a plan of attack that's based on earning 15% a year, because you'll probably be wildly disappointed. But remember why you're investing, and in times of uncertainty like we are right now, take a look and figure out how it's affected your long-term goals. So the conversations that we've been having with our clients is, here's what's going on the market. Here's how it's affected your portfolio. Nothing's changed with your retirement. So as of today, we can spend $1,500, a year less if the market never recovers. But we've talked about spending 10 grand a year in travel, and you're not going anywhere. You're not traveling anytime soon. So we'll make that up. The final piece that I want to show you right here is why adding bonds into your portfolio can be important. So what we're looking at here is these green bars are years in which the market has had negative years, and then the yellow bar that you're seeing is bonds and what they've done to counteract. So the reason that we put bonds in clients' portfolios, and the reason that a lot of you own bonds, isn't to hit grand slams. There's nothing overly sexy about them. But the way that I'll refer to it is, think of it as the insurance, the defense, or the flotation device that's a part of the equation. And when I talk about what you're hearing in the media and the market's pulling back, that's why when you open up your statements, although maybe they weren't where you wanted them to be when you opened them in March, it looks nothing like the market. So this is why you own fixed income in your portfolio. Just to wrap this up, because I am running short on time here, quick little summary. So we know moving forward that realistically we're going to see a recession here in 2020. We also know that for the majority of people, we need to have some exposure into the equity markets moving forward to achieve their long-term goals. That's going to be different from person to person. Some people might have 70% of their money in the equity markets. Some people might have 20% of the equity markets, but it still is a piece of the pie. We do know we're going to come out of this thing at some point. The $1 million question is when is it going to happen, and how quickly is the economy going to recover when we go back to normal? How am I doing for time, Ann?
Time. You've got a couple of minutes for questions.
I just want to show one more thing really quickly, if I can. Is that okay? Just gotta find it. Sorry. Maybe I won't be showing it. Okay. All right. Is my screen sharing again right here? I hope so. I'm just going to keep going. I can't hear anybody. But what I'm trying to show you right here is the media can be very, very powerful, to say the least. And there's been no lack of headlines that have been present over the past couple of months. So what we're looking at right here is, everybody's familiar with Time magazine. I know you are. So these are Time magazine articles that have been released over different decades over the past number of years. And most of these headlines that you're seeing aren't overly positive. What this slide here is showing is, so for example, this Time magazine was published, this Time magazine cover was published on January 21st, 1974. What this research is showing is what the market did 10 years after these magazines hit the newsstands. So you can just see throughout periods of history when times may have been nerve-wracking and everybody was telling you that the world was coming to an end and the economy was dead, well, you can see what's happened with regards to the market. So the point that I'm trying to make here is try to avoid making short-term decisions based on the event that we are in. So I feel like that can be a really powerful piece, and I wanted to take some time to show that. That is all I got. Thank you. Hope you learned something. Are there any questions? I think everyone's on mute. Can you still hear me?
Matt, I have a question. It deals with the household taking on of debt. Is that because interest rates got so low that we're such consumers that when we see something that looks like a bargain, we go after it?
Partially, yeah. So interest rates have been low for so long that we've been incentivized. And also, I don't know, best way to describe it, lack of discipline, right? It's easy to borrow money. You've seen you go and you get approved for a mortgage, and what you get approved for by the bank might be way more than you're comfortable spending, yet they'll still lend you that money if you want it. So yeah, it's interest rates have been low, and it's easy to rack up money on your credit card, right? It doesn't take you don't need any skill to go get a $20,000 line of credit or borrow a credit card. So it's put us in a bit of a pickle. Any other questions? We didn't even chat about energy. I didn't even have time for that today. That's been its own story. No. Well, if that's it, then.
Well, I see people talking and they need to unmute themselves. Press the space bar.
Hey, Matt, it's Myron here. Can you hear me?
I can hear you, Myron.
Good presentation. Just curious, maybe I missed it, dollar cost averaging, especially for a young person starting out anywhere in life, and the equity markets and kind of, averaging things out. Any quick hits on that?
So in an environment like right now, so for example, any new money that's come into our branch over the past couple of months, I get it. I'm not trying to make a prediction as to where the markets are going to go in a month from now, because I have no idea. So if people have brought money in, we've been using that theory. Let's take X amount of dollars and let's put money into the market every 2 weeks, every month, whatever it happens to be, to avoid trying to get it perfectly right or avoid getting it massively wrong. So at the end of the day, if you have money to invest, we know that we need to grow our money to achieve our goals. So whether you're going to do lump sum payments or dollar cost averaging, both solutions work well over the long term. But in an environment like today, and as uncertain as the markets are, it's a great strategy to get money invested.
Hey, Matt, I was just curious, why do you see opportunity in international markets?
Valuations, from a valuation standpoint, just they have been more attractive than the U.S. equity market for a while, and this just helps highlight that too. And again, it's not a portion of your portfolio, right? So it's not everything, but there's definitely opportunity there as well.
Hey, Matt, Colin here.
Oh, sorry. Go ahead, Colin.
Yeah, just curious what your thoughts are on the Norwegian blacklisting of Canadian energy companies and how seismic that will be in terms of our homeland portfolios.
So energy is an interesting topic, and it's had its challenges so far in 2020. So just to give a little bit of a highlight as to what we've seen from the energy standpoint. So energy, as of yesterday, was down about 54% year to date. So there's two aspects to it. There's a glut of oil that's been produced for a number of years. And then earlier in the year, in March, you saw Saudi Arabia and Russia go through their tizzy and continue to produce when OPEC was supposed to stop. And then through this pandemic right now, you see absolutely zero demand for oil. So you've got this oversupply and very little demand, and that's why you've seen oil be so challenged. moving forward, okay, we've seen energy prices rebound a little bit over the past couple of weeks, but there's still a ways to go before we get energy out of the equation. So I kind of bounced around. I didn't specifically. I lost track of your question. I'm sorry.
Well, I guess all I was saying is, in addition to that, where we're sitting already, do you think that this movement now, where you're seeing especially European funds actually formally blacklisting and pulling a major Canadian investment or energy investment out of their portfolio, do you see that being a nail in the coffin, or is it sort of a flash in the pan? You know, people's desire to see the markets recover might overlook that environmental aspect, or is it really something that's going to be in the psyche here to stay for investors?
No, it's not. It's not a nail in the coffin. Also, keep in mind too. So energy is one sector that we're investing in. So although energy has had its challenges temporarily right now, hopefully we're never building portfolios 100% exposed to energy. So there's some challenges that lie ahead, but energy is not dead. Let's just put it that way. There's a couple questions that have come in here. Jill, dollar cost averaging is just putting money into the market. Let's just say you're going to put $1,000 into the market on the first of the month, every month moving forward. That's what dollar cost averaging is. Jackie. Perfect. I think, yeah, with regards to elections, you'll see lots of short-term movement. I don't have the slide with me. I'm not able to present from work just because we're not operating on Zoom. But I have a slide that shows different elections and what's happened in the markets with different presidents. And whether it's a Democratic president or a Republican president, it's not going to drive the market drastically. It's not going to be a difference long-term. I think that's all the private questions that I've answered. Bank stocks. So if you take a look at the TSX, Dr. Murdoch, a good portion of the TSX is made up by energy stocks, bank stocks, and material stocks. So they do play a factor in the direction of the market. That being said, when you're investing your money, you don't need to invest your portfolio. The financial sector, you don't need to invest your portfolio just in bank stocks or just in Canadian banks. So the financial sector has many other aspects to it. So Canadian banks, US banks, REITs, insurance companies, life insurance companies, a company like Aflac, or those are all technically financial stocks. Anything else, or I think I've got all the private ones that came in. Perfect, thank you. Hope you learned something.
Did we lose Anne?
I did have to log her in a couple of times.
Yeah, so did I.
So I'm thinking we probably did lose Anne.
Okay, Mark,